Hello, everyone, and welcome back to Synaptic Investing. I hope you're having a fantastic week and are ready for another deep dive. We are so glad to have you with us today as we peel back the layers of the market to find those hidden gems and maybe some of those structural winners. Today, we're breaking down one of the most interesting companies on the market, I think. It's Verisk Analytics, ticker symbol V-RSK. Now, you might hear that name and immediately think, oh, a boring data company. And I need you to just reframe that right now. We are not just looking at a stock today. We are looking at the invisible backbone of the entire insurance industry. I mean, the absolute plumbing. And what's really caught our eye is that it's currently trading near its 52-week lows. It's hovering right around that 192 mark, a place we really haven't seen it in quite some time. And that brings us to the real question. On the surface, this looks like a fantastic business, powerful brand, incredible moat. But the real question for us as long-term investors is this. Are there hidden cracks in that fortress that the market is finally seeing?
That's what we're here to find out. I mean, think about it. We have a company that historically has been viewed as invincible, a literal monopoly with a guaranteed toll booth on risk. But the market has turned. The stock is down. The valuation has compressed significantly. And why? Because the market thinks artificial intelligence is going to kill this business. It thinks large language models, LLMs, make their entire data monopoly obsolete. So the question we are answering today, the one we're really going to dig into is this. Is Verisk a value trap, a fax machine in the age of email? Or is all this market panic offering us the chance to buy a true quality compounder at a discount we just haven't seen in a decade?
That is a huge topic. And frankly, it's the defining question for, I think, any data-heavy legacy business right now. It's a massive debate. Before we dive deep, just a quick heads up for the audience.
Right. If you're looking to invest, we use Interactive Brokers. Use the link in the description for a stock bonus when you sign up.
It's the best way to get a bonus and support the channel at the same time.
And while you're there, please like, subscribe, and let us know your questions in the comments. We do read them.
Now, let's get into it. Pillar number one, the business model and the economic moat.
Okay, I want to start by just stripping away all the corporate jargon here. When people hear Verisk Analytics, their eyes, they tend to glaze over. They just think it's another SaaS company selling dashboards or something. But if you really look at the plumbing of the insurance industry, Verisk isn't just a tool. It's the ground floor. We call this the toll booth on risk. But I want you to explain the core mechanism because it's kind of weird. It's this give-to-get model. How does that actually work in practice?
It is unusual. It's not intuitive. I mean, most software companies, they operate on a rent model, right? I build a tool, let's say it's Microsoft Excel, and you pay me $10 a month to use it.
Simple enough.
Verisk is completely different. They don't just rent software. They operate a refinery.
A refinery. Okay, I like that analogy. Explain.
Think about the raw material. The customers here are the big insurance carriers, the Allstates, the Travelers, the State Farms of the world. And every single day, they are generating millions and millions of data points. But this data isn't clean. It is a complete mess.
Right. It's not in a nice, neat little spreadsheet.
Not even close. It's handwritten notes from a claims adjuster in rural Ohio. It's a PDF of a police report from some fender bender in Miami. It's a grainy photo of hail damage on a roof out in Texas.
Okay.
It comes in hundreds of different formats from dozens of different legacy computer systems, some of which are probably running on code from, the 1980s.
So it's basically a dumpster fire of unstructured information.
It is a chaotic, noisy, absolute mess. And this is where the give-to-get model comes into play. The insurers, they send all this raw, messy claims and policy data to Verisk. That's the give.
They give their mess away.
Exactly. And Verisk acts as the central black box. They take in all that crude oil and they refine it. They clean it, they aggregate it, they anonymize it, and most importantly, they structure it into a standardized format. They turn vehicle impact side, 30 mile per hour, into a very specific actuarial code that means the same thing for every single client.
Then they turn around and sell it back to them.
Then they sell the refined product, the standard of truth, back to the carriers. That is the get. The output is the actuarial table. It's the statistical probability of risk cleaned and verified.
Okay, but hang on a second. This is the part I've always struggled with. If I'm State Farm, right, I have, roughly 19% of the U.S. auto market. I have millions of customers. I have this massive internal database of my own accidents, my own claims. Why on earth would I take my proprietary data, my crown jewels, and just hand it over to a third party who I know is also working with all my direct competitors?
Right.
Why don't I just keep it and build my own model? It seems crazy.
It seems crazy, but it's because of the law of large numbers.
Yeah.
This is the fundamental bedrock law of the entire insurance industry. You might have 19% of the market, which is, it's huge. But what that really means is you don't see the other 81% of the market.
Sure, but is my 19% not a large enough sample size to be statistically significant? It's millions of data points.
For the really boring, common stuff, maybe. You probably know exactly how often a 2018 Honda Civic gets into a minor accident in the suburbs. You have enough data for the average day.
But insurance isn't about the average day.
Yeah, exactly. It's about the edge cases. It's about the disasters. It's about that really specific liability claim involving a new type of electric vehicle battery fire in a very specific zip code. Even a giant like State Farm might only see that specific edge case, say, 10 times a year. That is not nearly enough data to price a policy accurately. You are effectively guessing.
And guessing is how you go bankrupt in this business.
One bad guess on a huge liability line can wipe out an entire year of underwriting profit. But Verisk, because they sit in the middle of everyone, might see that same edge case 5,000 times a year. They have the statistical significance that no single carrier, not even the biggest, can replicate on their own.
So State Farm gives up their slice of the pie to get a look at the whole cake. They trade their privacy for accuracy.
They trade a little bit of privacy for a massive reduction in uncertainty.
Correct. And the value proposition there is just, it's undeniable.
So it's not the software interface that's the product. It's the pooled blindness. It cures the blind spots for everyone. That's a perfect way to put it. And the revenue model attached to this is, from an investor standpoint, just beautiful. It's a double dip.
How so?
They get a recurring subscription fee just for access to the database. Think of that as like the cover charge to get into the club.
Okay.
But then on top of that, they also charge volume-based transaction fees. So every time an insurer runs a check on a new policy or writes a policy or queries the database for a driver's history, click, the meter runs.
Wow. So it is literally a royalty on the economic activity of the entire insurance industry.
It's a toll booth on risk transfer. The more policies that get written, the more money Verisk makes. It's tied to the industry's pulse.
That sounds fantastic, but let's poke some holes in it. We see data aggregators come and go all the time. Usually, eventually, the big players get annoyed with paying the middleman and they leave. So why is this so sticky? If I'm a massive insurer and I hire a bunch of PhDs from MIT, why can't I just say, you know what, thanks, but no thanks, we'll figure this out on our own? Is it just about the data volume, or is there something else locking them in?
It's not just the data volume. That's a big piece. But if it were just data, I think you'd see a lot more churn. The real deep structural moat is what we call systemic necessity. And it really comes down to two words: regulatory lock-in.
Ah, okay. This is the boring but profitable part of the story.
This is the part that turns a good business into a fortress. You have to remember, insurance is a statutory industry. It's not the Wild West. You can't just charge whatever you want for a policy.
Right.
If you want to raise your car insurance rates in a big state like California or Florida, you have to go to the state insurance commissioner, a government bureaucrat, and you have to ask for permission. You have to file a formal rate case.
And you have to prove that the rate hike is justified by the data. You have to show your work.
You have to show your work. Now imagine you go to that regulator with your fancy homemade model from your team of MIT PhDs. The regulator's going to look at it and say, what is this? I don't understand this math. I can't verify these inputs. I don't trust it.
Yeah, they'll just say no.
But if you walk in with a filing based on Verisk's data, the regulator just nods. And why? Because the regulator uses Verisk too.
Wait, the regulators themselves are customers of Verisk.
In many, many states, Verisk's filings are the benchmark. They are the accepted gold standard. So the regulator and the regulated are speaking the exact same language, Verisk's language.
Whoa.
So if a carrier stops using Verisk, they are effectively breaking communication with their own regulator. They risk non-compliance. They risk having all their rate hikes rejected because they can't justify them in the standard accepted format.
That is a massive, massive friction point. It's not even a technical problem at that point. It's a bureaucratic hostage situation.
Hostage situation is maybe a bit aggressive, but yes. It creates what economists call zero elasticity. Verisk can raise prices by 5%, 6% a year, and the insurers will grumble, they'll complain, they'll hate it.
But they pay.
But they pay. Because the cost of switching isn't just buying new software, it's rebuilding your entire regulatory compliance strategy from the ground up. And nobody wants to do that.
Which brings us to the mental models. We always talk about Charlie Munger's Lollapalooza effect, when you have multiple powerful forces all pushing in the same direction. So here we've got the network effects. More data equals better models equals more customers. And we have these incredibly high switching costs thanks to the regulator.
There's a third force here, too, that I think gets overlooked, and that's culture.
Culture.
Yeah. We usually look for, innovation cultures in the companies we buy. We want that move fast and break things, Silicon Valley energy. Verisk is the complete opposite of that. It is bureaucratic, it is slow, it is stable.
And normally we'd look at that and say, that's a bad thing. That's a sell signal right there.
In most industries, yes. If this were a social media company, I'd be terrified. But here, the bureaucracy is actually a feature, not a bug.
How so?
It perfectly mirrors the culture of their clients. Insurance companies are, by their very nature, risk-averse. They are slow. They value safety and predictability above all else.
Right. They don't want disruption.
They absolutely do not want a vendor who is disrupting things every 6 months with a new update. They want a vendor who speaks compliance. Verisk's boring, stable culture aligns perfectly with the customer's deepest needs. That cultural alignment actually strengthens the moat.
That's a really interesting counterintuitive point. Being boring is a defense mechanism. However, and this is the real pivot point of our entire deep dive today, that same slowness, that same grandfathered safety is exactly what has the market so terrified right now. Because while Verisk has been quietly refining its actuarial tables for 50 years, the world outside has changed a lot.
Which brings us directly to the reason the stock is sitting at 52-week lows.
Exactly. Pillar number 2, the red team challenge, the AI thesis.
And I want to spend some real time here because we absolutely cannot dismiss this. This isn't just market noise or a bad quarter. This is a fundamental question about the future of organized data. The bear case is brutally simple. You are buying a fax machine in the age of email.
Oof, that hurts. It implies total unavoidable obsolescence.
Yeah. It does. And the core of the argument is that we are moving from an era of data scarcity to an era of inference abundance.
Okay, you have to explain that distinction.
Yeah.
What exactly is inference abundance?
Okay, think back to that messy pile of data we talked about earlier. The handwritten notes, the PDFs, all that chaos.
The dumpster fire.
Dumpster fire. Historically, the value in that data was scarce because it was unusable until Verisk came along and structured it. Verisk was the only one who could read the mess.
Right.
But what do large language models, LLMs like GPT-4 or Claude, what do they do best?
They read messy data. They understand context. They see patterns in unstructured information.
Exactly. They thrive on it. So the bear case is this. What if State Farm doesn't need Verisk to clean the data anymore? What if they can just take their entire internal data lake, all those PDFs and emails and photos, feed it into a private, secure instance of an LLM, and just say, hey, AI, look at these 10 million claims and tell me the risk probability for a 30-year-old male driving a Ford F-150 in Chicago.
And the AI just does it. It infers the pattern without ever needing Verisk's rigid, structured actuarial table.
It creates a dynamic, real-time risk model that might actually be better than Verisk's static 20-year-old table. It can find correlations that a human actuary would never, ever look for.
Like what?
I don't know. Maybe it notices that people who buy red cars and also subscribe to a certain fishing magazine are 2% more likely to have an accident on a rainy Tuesday. An LLM finds that correlation instantly. A human would never even think to check.
So if the internal AI becomes superior, or even just good enough, compared to the pooled external data from Verisk, the entire give-to-get model collapses.
That is the death spiral scenario. If the top 10 insurers, who, remember, hold about 70% of the market, if they all decide their internal AI is good enough, they stop contributing to the pool. Why would they give their most valuable data to Verisk if they aren't getting superior value back? And the moment they stop contributing, Verisk's database starts to degrade, it becomes stale, the network effect runs in reverse.
It's the empty shell scenario. You're left paying 26 times earnings for a database that is rapidly losing its relevance and its data feed.
And we have to be honest with ourselves and with the audience. Technological shifts like this do happen. Look at encyclopedias. Encyclopedia Britannica had the best content, the best experts, the best brand, a huge moat.
Right.
Then the internet happened, and good enough information from Wikipedia became free and abundant. Verisk is Encyclopedia Britannica in this analogy, and AI is the internet.
That is a terrifying picture.
Yeah.
And if I look at the stock chart, that is clearly what the market is pricing in right now, that exact fear. But So I'd have to play the defense attorney here. I think there are some massive practical flaws in that death by AI narrative. It sounds great on a Silicon Valley whiteboard, but does it actually work in a wildly regulated, slow-moving market like insurance?
You're going right back to the regulator, aren't you?
I am. Because that's where the rubber meets the road. Let's play out that scenario you just described. State Farm builds its super smart AI. They walk into the California Insurance Commissioner's office. They say, we want to raise rates by 20% on this group of people because our proprietary AI black box said so. The commissioner asks, why? And the State Farm data scientist says, well, because of a complex, nonlinear pattern in the neural network that we cannot explain or audit. What happens next?
They get laughed out of the room immediately.
Exactly. It's the black box problem. Regulators, and by extension, the courts and the public, demand explainability. They need to be able to point to a specific, understandable, factor-like number of speeding tickets or age of driver and say, this is why the rate went up. LLMs are famous for hallucinations and for being opaque. Can you imagine the political and legal nightmare if an AI started charging higher rates to a specific demographic based on some weird correlation that nobody could understand or justify?
It would be a lawsuit bonanza,
Yeah.
a complete disaster.
So my argument is that the friction to adoption is just too high. The standard of truth in a regulated industry needs to be explainable, not just predictive. Verisk provides that audit trail. AI provides a guess, even if it's a really smart guess.
I agree with that in the short to medium term. I think you're right. That regulatory wall is very high.
Yeah.
But I'll challenge you on the long term. 10 years from now, regulation adapts.
That's it.
It does, slowly. We are already seeing the first generation of explainable AI being developed. If the AI model is proven over time to be 50% more accurate at predicting losses than the old actuary table, eventually the market and the regulators will have to adapt. Economic efficiency usually wins in the end. It just takes time.
That's a fair point. But eventually it can be a very long time in the world of insurance. And in the meantime, Verisk isn't just sitting still waiting to be replaced. They can integrate AI into their own products.
Yeah. That's the bull case, that they become the ones selling the AI tools to the industry rather than being replaced by them. But okay, let's shift gears for a second. We've established the business is, great but existentially threatened. Now we need to look at the estrogen under the hood right now. Because even if the AI apocalypse comes in 10 years, the cash flow being generated today is staggering.
Yes. Pillar 3, financial resilience and capital allocation.
We always need to test the quality of earnings, because not all earnings are created equal, as we know.
And the grades Verisk gets here are, frankly, elite. We are talking about operating margins that are consistently in the 37 to 44% range. That is rarefied air for any company.
That's what confirms the economics we were talking about. It is a true software and data business. Once the database and the models are built, the marginal cost of selling access to one more customer is basically zero.
Right. But I want to highlight something that usually drives me crazy with modern tech companies, and that is stock-based compensation, or SBC.
Ah, yes, the hidden expense.
We see this all the time, don't we? A trendy SaaS company claims they are profitable on a non-GAAP basis. But then you look at the cash flow statement, and you realize they are printing millions of new shares to pay their engineers. They're diluting you, the shareholder, by maybe 15% a year just to keep the lights on. It's a huge wealth transfer from the owners to the employees.
Verisk is the anti-SaaS company in that regard.
Completely. You look at their numbers, and SBC is roughly 4 to 6% of their operating expenses. That is remarkably low for a tech-adjacent company. It tells me that the culture isn't run by engineers demanding huge equity packages. It's run by, frankly, accountants who are focused on shareholder returns.
And the cash flow conversion backs that up too. Their free cash flow to net income is consistently over 100%. This means the earnings you see on the income statement are real, actual cash hitting the company's bank account. It's not just accounting magic.
Which brings us to the really interesting part for me. What do they do with all that cash? Because this is where the thesis gets really compelling. We need to talk about the Cannibal trait.
I love a good cannibal. For those in the audience who haven't read the book The Outsiders, a cannibal is a company that aggressively, consistently eats its own stock through buybacks.
Let's just look at the math here. Verisk generates massive free cash flow, but their core business is capital light. They don't need to build new factories. They don't need massive R&D spending just to maintain the database. Their return on invested capital is somewhere around 21 to 27%. Their cost of capital is maybe 8%. They're just swimming in excess cash every year.
So they have two choices, really. They can go out and do acquisitions, buy other companies, what we call empire building, or they can return that cash to shareholders by buying back their own stock.
And recently, they have chosen incredible discipline. They actually sold off their big energy consulting business, Wood Mackenzie. They divested it.
That was a huge, huge signal to the market. A typical CEO wants to run a bigger company, a more complex company. Bigger company usually equals a bigger bonus, a bigger ego. Verisk's management looked at Wood Mackenzie, which was a decent business, and said, this isn't our core insurance mode. This is a distraction. Sell it. That gets a huge thumbs up for me. They are simplifying, not complicating. They're focusing.
And then the buybacks. They are taking that cash and they are buying back stock right now at these 52-week lows.
And this is where the current low valuation really protects you as an investor. If they were buying back stock at $250 or $300 a share, I'd be skeptical. I'd say you're probably destroying value by overpaying for your own shares. But buying at 192, they are retiring shares at a significant discount to what we think is the intrinsic value. They are effectively increasing your percentage ownership of this great company for free every single quarter.
It creates a mathematical floor under the stock. I mean, think about it. Even if revenue stays flat, let's just say the AI threat completely stalls their growth at 0%. If they can retire 4% of the shares outstanding every year, your earnings per share still goes up by 4%.
It's the silent compounder. You don't see it in the flashy headlines, but you see it in the share price over 5 years. It's an incredible tailwind.
So we have a fortress business, a scary narrative, but a management team that acts like a true owner. The final piece of the puzzle now is the price tag. Is it cheap enough to compensate us for that AI risk?
Right. Pillar 4, valuation and the trade.
Let's try to do a reverse DCF here, a reverse discounted cash flow. So instead of us guessing what they will do in the future, let's look at the current stock price and calculate what the market is implying they will do.
Okay. So, current state. The stock is at roughly $192. The forward PE multiple is about 26.5 times.
Now, historically, for years, Verisk traded at 30 to 35 times earnings. It was viewed by the market as a quality compounder, in the same bucket as a Costco or a Sherwin-Williams. You paid a premium for the certainty and the quality.
That premium has completely evaporated. We've gone from a 35 multiple down to a 26. That is a massive, massive compression in what the market is willing to pay.
So at 192, with a 26 PE, what the market is effectively pricing in is roughly 8 to 10% earnings growth for the next decade.
Which is pretty conservative, isn't it?
It feels very conservative if you believe the moat holds. Historically, they've done better than that. If they can just keep hitting singles and doubles, the stock today is undervalued.
Okay, but here's the bear argument on valuation. You said 26 times earnings. Is that actually cheap in an absolute sense? I mean, I can go buy Microsoft or Google for 20 to 25 times earnings, and I get exposure to massive secular growth trends.
Right.
Why would I pay 26 times for a, let's be honest, boring insurance data company that might only grow at 7 or 8%?
That is the toughest question to answer. And I think the answer depends on how you view risk. With a Google or a Microsoft, you have huge execution risk. You have antitrust risk. You have technology disruption risk from the next startup. With Verisk, if the moat holds, you have something much closer to utility-like certainty. You aren't paying for hypergrowth. You're paying for the guarantee.
So you're treating it almost like a high-quality bond with an equity kicker attached.
Exactly. But let's try to pin down a specific buy zone. If we use a very conservative owner earnings model, and let's assume we want at least an 11% return on our money to make it worth our while, my math gets me to a fair value of right around $185.
And we are hovering right at 192 today.
So we are right there. For the first time in at least a year, maybe longer, there is no quality premium baked into the stock price. You are essentially paying a fair price for a great business.
But, and there's always a but, we need a pre-mortem. When do we sell? If we buy today at 190, what event would cause us to panic and dump the stock? We have to define our kill criteria up front.
This is critical. You cannot marry a stock. You have to know your exit conditions.
Kill criteria number 1 for me is the anthropic obsolescence we talked about. We need to watch the customer list like a hawk. If we see a major carrier, a State Farm, a Progressive, a Geico, publicly announce they're ending their data contribution contract with Verisk or even significantly reducing it,
That is a 5-alarm fire, sirens blaring.
that is the canary in the coal mine. It would mean the network effect is officially breaking. If you see that news, you sell. You sell immediately. Do not ask questions. Do not wait for the next earnings call to see what management says. Just get out.
Kill criteria number 2, the regulatory cap. This is the utility risk. If regulators suddenly decide that Verisk is too powerful and they start treating it like a water company, capping their pricing power, forbidding price hikes above inflation, then the entire multiple collapses.
Right.
A regulated utility doesn't trade at 26 times earnings. It trades at 15 times. So if you start seeing headlines about data antitrust investigations or pricing caps on insurance data providers, the thesis is broken.
So we are watching customer churn and the regulatory newsfeed. Those are our two tripwires.
Precisely. We aren't being passive investors here. But if those two things don't happen, we have to look to the long term.
Which brings us to pillar 5, the 10-year horizon. Let's look out to 2036.
I want to paint 3 different pictures for you. 3 possible roads this company could travel down over the next decade.
Okay, let's walk through them. Road A.
Road A, the data utility. This is the bear case winning. AI successfully commoditizes risk data. It becomes cheap and abundant. Verisk survives, but it loses all of its pricing power. They just grind out, say, 4% growth a year, basically matching GDP. And the multiple compresses down to a utility like 16 times.
And the result for a shareholder who buys today.
Dead money. The stock is trading at roughly $170 in 10 years. You collect a few dividends, but inflation basically eats all your returns. That is the value trap risk.
Not a great outcome. Okay, road B.
Road B, the standard of truth. This is our base case. This is the scenario where the moat holds. The insurance industry proves to be as slow to change as we think it is. The regulators insist on Verisk's explainable data. Verisk keeps buying back 2 to 3% of its stock every single year, and they grow EPS at a steady 10%.
This feels like the most probable outcome to me. Inertia is just such a powerful force in these old industries.
In this scenario, the share price hits roughly $450 in 10 years. That gets you a 9 to 10% IRR. You solidly beat the market, probably with lower volatility. It's a solid double, a great investment.
Okay. And road C. Give me the bull case. What has to go right?
Road C, the risk sovereign. This is where Verisk successfully pivots. See, right now, Verisk is mostly a rear-view company. They sell history. Their core product answers the question, how many fires happened in the zip code in 1990?
And for the bull case to play out, they need to start predicting the future.
Exactly. They need to successfully monetize new risk. Climate change is the biggest and most obvious one. They need to build the definitive models that answer, what is the probability of a catastrophic wildfire here in 2032? Or cyber risk, or geopolitical risk. If Verisk can become the MSCI of risk, if they can own the universal language of future prediction, not just past recording, then the multiple expands back up to 30 times or even higher.
That's the comparison. MSCI owns the language of ETFs and equity indexes. Verisk wants to own the language of risk transfer.
If they pull that off, the stock goes to $800 plus. That's a 15 to 16% annualized return. That's a true home run.
But that requires real execution. That requires them to build new products and innovate, not just milk the old cash cow.
It does. So what we're really doing is we're betting on the base case with the free call option on the bull case.
And there's an income angle here, too, as we look out. As the company matures, those massive buybacks might start to shift toward dividends.
Yeah.
If you buy the stock at $192 today, and in 10 years they start paying out, say, 50% of their earnings as a dividend, your yield on cost could be 4 or 5%. It slowly transforms into a bomb that grows.
So let's bring this all home. The final verdict, what's the takeaway?
Let's summarize the scorecard for everyone.
Okay. Quality score. High GH. The moat is dominant, the margins are elite, the management team is disciplined and shareholder-friendly. Top marks.
Valuation score. I'd say fair to cheap. It's trading at the absolute bottom of its 52-week range, and the multiple has compressed significantly due to this AI fear.
The asymmetry is what I really like here. You are paying for a struggling utility, that's what the current price implies, but you are potentially getting a global monopoly on sale.
The downside feels capped by the low valuation and those aggressive buybacks. The upside is driven by that strategic pivot into new risk areas.
So the action plan. How should someone listening think about this?
For me, this is a classic accumulation play. You don't go all in today. You don't back up the truck. You nibble. You slowly build a position in this $185 to $200 zone.
Right.
And this is critical, so listen closely. You have to be patient. You have to expect boring, choppy price action for the next 12 to 18 months.
Why that long?
Because the AI fear narrative is not going away overnight. Every time OpenAI or Google releases a new, more powerful model, this stock might take a hit. There will be headlines.
You'll be tested.
You will be tested. You have to be willing to hold through that narrative noise. You need to give the Cannibal math, the buybacks, the time to work their magic. This happens over years, not weeks. This is a get-rich-slow investment.
Get rich slow.
Mhm.
It's not a sexy slogan, but it's the one that works. And that brings us to the end of our deep dive. But before we go, we always like to leave you with one final provocative thought to chew on for the week.
Here's the thought I want to leave you with. We spend so much time and energy worrying about AI replacing the old guard. We worry about Verisk being a dinosaur, a relic. But I want you to flip that idea on its head. Think about the world we are rapidly entering. A world of deepfakes. A world of synthetic data. A world where AI can hallucinate convincing lies at infinite scale and zero cost.
It's a world where the concept of truth becomes scarce. Very scarce.
Exactly. In a world of infinite synthetic noise, doesn't a verified, grandfathered 50-year-old database of real, physical, historical events actually become more valuable, not less?
That is a profound idea. When you can't trust what you see, you trust what you know happened.
Maybe the truth is the only asset that truly inflates in an AI world. Maybe Verisk isn't a fax machine at all. Maybe it's the vault where we keep the gold standard of reality. And in the long run, people will always pay a premium for reality.
I love that. The value of truth in a synthetic world. Something to think about as you watch the charts this week. Thanks for watching Synaptic Investing. We'll see you in the markets.